My message today is very simple. Hedging done well makes sense. I'll say that again. Hedging done well makes sense. If you don't keep track of everything else I say, just please remember that. Hedging done well makes sense. I've been saying it since 2004. We've been proving it in the work that we do with our clients. That's correct. And I'll show you why the people who've been telling you shouldn't hedge, or they'll trash your share price, or you shouldn't buy companies that hedge because they lack imagination or foresight, or they're not believers in the gold price, is all BS. Companies that hedge seem to stand out positively. And it's not due to hedging per se. I'm not going to suggest the numbers I show you that these companies have done better than their peers because they hedge. I'm going to contend simply that the willingness to hedge, the willingness to admit that you can't predict the gold price, but you can have some control over your cash flow in a business that's very cash consumptive, is the mark of not good, but great managers. That's what you will find when you look. So whatever the financial forecast, it pays to be prepared. I was a Boy Scout, be prepared. You can't predict, but you can prepare. Now that's not an oxymoron. If there is a moron, oxy or otherwise, somewhere in that whole thing, it's the guy, and yes ladies, it is a guy. Generally ladies I find are much better at this thing, they measure risk a lot better. It's a guy who thinks he knows where the gold price is going and he knows when it's going to get there. That is the most dangerous person to have in any boardroom of any gold mining company. So I'm not that guy. I subscribe to several simple mantras that we try and get our clients to repeat over and over again. One is that the gold price will always go where you expect it to go, but it never goes there when you expect it. And the other one is, it is always better to be approximately right than precisely wrong. Mark Twain said, it's not what you don't know that gets you into trouble. It's what you know to be true that just ain't so that gets you into trouble. And that is very much the case when it comes to gold. And I've been in gold for 35 years, started when I was in primary school, clearly. I've been in the gold market for 35 years, and every year someone stands up and tells me the end of the world is coming very soon and I should own some gold. I've made a good living in bull markets and bear markets by not having too strong a view on where it's going and understanding it doesn't always go in one direction. Because every time someone buys it or sells it, they're doing that because they want to buy or sell something else. It's an alternative. It's one thing. It's not the only thing. And you have to understand that. The problem is when you run a gold mining company, the only thing you get to sell is gold. And you have to sell it every week of every month of every year that you're in production. And that's a very, very different equation. So you can't listen to the end of the worlders, and you don't want to listen to the economists who predicted 10 of the last 4 recessions either. So, just let you absorb that for a minute. That should have been worth a laugh. I didn't get one you clearly didn't understand. So, one of my great heroes in the gold market, if you do want to have a view on gold, you want to get a good balanced view, write down "In Gold We Trust." If you don't read the report already that comes out of Liechtenstein from Ronnie Stoffel, then you should have a look at that. It's one of the best balanced reports. I read all 200 pages. I don't expect all our clients to read that much, but I love it. And there's lots of pictures, and this is one of the pictures that Ronnie puts up as a very good reason, and he popularised this, and this is all over Twitter and everywhere. What are you looking at? You're looking at the ratio between the Goldman Sachs Commodity Index and the S&P 500. When it's high, it means equities are very low and commodities are high in value. And when it's low, it means commodities are relatively cheap relative to shares. Now you can see in 2017 when he first produced this that commodities were very low. Now what does that actually mean? Think about it this way. You can sell one, if you sell at the bottom, if you sell a basket of commodities, and there's a whole heap of commodities in there. Gold only makes up 4.4% of the basket, by the way, which is why it's not so good for gold. But if you sell your basket of commodities, you're going to go and buy one of every share in the S&P. At the height, when equities are low and commodities are high, you can sell that same basket of commodities and buy 8 times as many shares, okay? So what does it say at the moment? Clearly says commodities are incredibly cheap. The basket of commodities, about 40% energy and 4% gold, is incredibly cheap. I likened this in a presentation that I gave, that what this is telling you as a commodities investor, more broadly than gold, but as a commodities investor, and gold is commodity and currency, wonderful both sometimes, some are terrible both. This is like if you imagine I'm Russell Crowe, done up in all the gear like sort of a gladiator or something, and we're going to get the city, all the people who think we're going to, the institutions we're going to beat, all the central banks we hate, we're winding back a catapult. And they're winding back this catapult, and this catapult is here, and someone has to cry, let loose, and they cut it with an axe, and commodities are going to go launching into the atmosphere. That's what that picture tells you. You should be buying very cheap in-ground commodities. You should be selling equities, general equities, and buying commodities. That's what that picture's telling you, but it's not telling you how long until someone's going to cry, when do you cut the rope? But commodities are as cheap as they were in the late 90s, and they were in the early 70s, and both times after that, we had a big run in the gold price, which is why Ronnie puts up that graph. But the problem there is if you look at it, those of you who follow the gold price closely will know that the gold price had one of its best rallies from 2008 to 2012, where that ratio was falling. So like with all ratios, you've got to be very mindful of lots of things going on. But generally, commodities are cheap. This is the right time to be coming into the sector, no doubt, no doubt. So that's been popularised, and that's one of the reasons why gold producers are told don't hedge, because commodities are cheap. Let's get a bit further on. That's the same picture again, blown up a little bit, and this is what the charts that our clients are used to seeing. Red means it's in downtrend quite clearly. We have a scoring system that we use. Green means an uptrend. If you look at that quickly, you'll see there's more red than green. That tells us it tends to spend more time falling than it does go up, so the rallies are brief. And we know that to be true. Those kind of bull market things are true. Now, don't forget, when this ratio is going up, it either means equities are falling or commodities are going up. This ratio can go up even if commodities are falling. It just means equities are falling more, like in the GFC, for example, and post-GFC there. You see that spike in 2008. Commodities were falling, but equities were falling further, because equities can go to zero much faster than commodities can. Copper can't go to zero. Copper companies can go to zero very quickly, as we saw during the GFC. What's interesting there is that's now a year on from when Ronnie produced this thing, and the reason everyone's so pissed off and selling their gold shares and their commodity shares, and the little tin miner I bought for 1.6 cents, what I thought is cheap, is now even cheaper at 1 cent, is because this is still low. Why? Because equities are still going up. And that's a very important thing to remember, and hopefully I'll finish on that note. The most important thing to remember about when it is actually the right time to buy gold, and if you are going to try and time it. You should always own some, but when you really want to go for the doctor, then you want to be paying attention at the end here. So what have we got here? Why did hedging get such a bad name? I'm not going to apologise that I put this up every single time that I speak about this subject, but that blue histogram is the growing volume of hedging of gold producers that grew from 20 million ounces to 110 million ounces, and that was 110 they told you about in their annual reports. Companies like Sons of Gwalia and Ashanti and other had a whole lot more that they weren't telling you about in their annual reports. So hedging was growing. The interesting thing is people were selling more gold as the gold price was falling. Gold producers didn't believe in their own metal. They were hedging more and more. Why? Because they were trying to keep unprofitable mines in business. So as I said at the beginning, sensible hedging, it makes good sense. This was not sensible hedging, and particularly you can see the penultimate thing where the biggest spike was there was actually when the price was the lowest. So the lower the gold price got, the more people had to hedge. Well, they did, because they had to sell more and more at a fixed price to try and keep the mines open. They should have been shutting mines. That's the reality. So what's interesting is then, of course, they got the idea, Pierre Lassonde got the idea that you should buy your hedging back. He did that in the early 2000s. He bought Normandy, bought their hedging back, made a profit. Everybody else was buying back their hedging or delivering it and running it down all the way to the high. So gold producers were one of the biggest boosters of the rally. And what you can see today is that if we blow in and we look closely since 2010, gold hedging got down to about 2.5 million, and now it's up to about 9 million. All right, 9 million, it got up to high about 8 or 9 million ounces. From 110, declared probably 150. All right, so when I was down at the 2 million mark and my business is helping producers hedge, I said to someone, I feel like I'm a buggy whip manufacturer. I make a beautiful product, it's just that nobody wants to buy my product anymore. No one wants to hear about how hedging can work. But thankfully, our clients particularly had the courage to start hedging, and to the extent that our clients represent about a quarter to a third of all the companies in the world that hedge, it's them having the courage to do it and not getting beaten up in the share market and actually showing that you can run a business and do hedging that started to allow other companies to hedge and be comfortable to do it, and that list is growing. And an interesting one, for example, is Evolution, who actually took over a company called Catalpa, who was one of our clients, and they rang up shortly after. The CFO rang up and said, oh, how much would it cost to close out the hedging? And I said, well, that's the best asset you got in the deal. He said, well, you don't understand, Sean, hedging's out of the money. It must be a liability. It would cost money to buy back. I said, no, having a mine without hedging in the current environment, that's a potential liability. When in 2013, when the gold price collapsed, up until that point, Jake Klein had always said to people, we don't hedge. because that was back in those days you didn't hedge. He said, we don't hedge, but we bought this mine that had some hedging, so it's the Edna May hedge, and it's over here, and it's just for Edna May. When the gold price fell in 2013, every mine manager in the group in Evolution was saying, hey, can I deliver my gold into that Edna May hedge? It very quickly became the Evolution hedge, and Evolution very quickly came out of the closet and was no longer a non-hedger. They were a hedger, and they've hedged ever since. So, anyway, look, from 2.5 million to 8 million, who knows, this thing could catch on. My view is that the healthy volume for hedging for the industry worldwide should be between 30 to 40 million ounces of hedging. That if mining companies had, for the amount of debt that gold mining companies currently have, it should be much more than that. But they've got too much debt. And debt and hedging are necessary bedfellows. Certainly what you know, if you're really looking for geared play on gold and you think you know where the gold price is going, then you buy the guy with no hedging and lots of debt. Or if you're a short seller, you short sell them if you think it's going down. And that's certainly why companies with high levels of debt and no hedging in the mining industry get attacked by short sellers in the falling market. And companies like Kingsgate got into huge trouble in 2013, wondered why they had 10 or 12% short register. It was because everyone's saying, well, if you've got debt and no hedging, the gold price only has to go to here for you to go to zero. I don't need to sell gold for a couple of $100. So companies with debt and no hedging tend to attract short sellers. I'm not advocating on that basis that you should hedge to get the short sellers off your register. That's not a good idea. Run your business well and you will never have short sellers on your register until the gold price is so high they're starting to think something different. Now, one of the reasons that hedging is catching on is this is an index of different gold prices in different currencies since the lows in 2013. Now, in a couple of slides on from now, you'll see that the Russians are actually the biggest hedgers in the world. Interestingly, the Russian central bank is also one of the largest buyers, as you would have seen in bronze thing. It's a no-brainer for the Russian central bank. You make a rule that everybody in Russia has to sell all their gold to you, and you pay them in ruble. You really don't care how many ruble you have to print. You get the gold. In the long run, he who has the gold makes the rules. Vladimir already makes the rules, but now he's got all the gold as well. And they will never be handing out that gold to the people, let me tell you. It's already been allocated between about 6 guys. But people in North America, when I talk to them and I say, our Australian clients hedge and they don't get beaten up in the share price, maybe you should think about being a more rational, sensible manager of your company. I don't put it quite like that, but that's the subtext. They say, Australians are just lucky because they're not really selling gold well, they're just buying the Aussie well. It's just because the Aussie's low. There's down. I go, no, hang on. If my companies are making 700 or 800 Australian dollars an ounce of margin and locking that in with hedging, that's still a lot of US dollars. That's still $500 US a margin they're making. Not many companies in North America making that kind of margin, but the point is that they're locking in modest amounts, and we'll get to that in a second, how much people are actually hedging. Back in the day, when we had that 110 million ounces, we had this massive position, and people were selling way into the distance, and they were selling at levels that didn't make sense, and they weren't locking in their fuel, so they were selling gold at, call it $700, and oil was $30 a barrel, and they'd go and forward sell all the gold, and then gold would be $1,000, and oil would be $120 a barrel. If you're going to hedge, you've got to lock in your margin. One of the things you'll see with our clients and other people in the hedge, once they start to hedge and manage, they're also locking in fuel. A lot of our companies that have got gold hedging, if they've got a high fuel consumption, have also locked in fuel at lower levels. That's true hedging. They're locking in operating margin. But here, what you clearly see is there is an incentive to hedge. There's still no doubt, and I don't think you should ever hedge because the price is high, because I don't know what high is. But it is certainly easier for a Russian company or an Australian company or a Brazilian real producer. You see that silver line there, that's the Brazilian real. Brazilian real gold price is at all-time record highs. South African rand is within 10% of all-time record highs. Russian ruble, a couple of weeks ago, in fact, before I went on holiday, so in June, the ruble gold price was up, up at highs. We had $13.50 US. 5 weeks ago, Russian ruble price was as high in Russian ruble terms as when US gold was at $13.50. So US gold producers say, well, I'm not going to sell here because it's $12.20. Who would sell here? Russians are happy to sell at $12.20. They don't care if it's $11.50, whatever it is, if the Russian ruble price is up to the prices they like. So they keep topping up their hedging. You see there South African rand, Brazilian real, and then Aussie down there, and the CAD. So Aussie and CAD producers are still enjoying much better gold prices than we saw in the depths of 2013. US producers are getting the same price today as they were at the absolute depths of the darkest days of 2013. That's why they've still got a lot of debt. And you've got Barrick and Randgold and those guys trying to sort of solve their problems. I don't know how the relative resources put together doesn't change automatically, but I'm a huge fan of Mark Bristow and I sincerely hope that he can make a big difference there. But interestingly, those are two companies that don't hedge, and we'll see how they performed in the share market relative to people that do in just a moment. So there's the breakdown, courtesy of Goldfields, Mineral Services and Thomson Reuters, the top 10 hedges in the world. Interestingly, Goldfields Limited is one of the highest. Most of that's Australian dollar gold for their Australian assets, and again, because Australian gold was high, and they seemed to do it around the time they took on Gruyere as well, so I think it was kind of, well, let's high gold price, we've just got a whole lot more ounces in the ground, let's go and lock some of that in. Also hedged a lot of oil a couple of years ago at much lower prices, so Goldfields have kind of got the knack of it. Unfortunately, it hasn't helped them too much in the share market, but they've got bigger problems, I think. But overall, they're the largest hedger. Newcrest, interestingly, who swore on a stack of Bibles, previous MDs wouldn't hedge. The most recent MD, Sandeep Biswas, is certainly much more of a continuous improvement, small incremental guy. And when they couldn't sell Telfer and they realised they were going to have to do a $500 million cutback, they decided to hedge to make sure that they could actually be profitable through that cutback and beyond. And now they're the second largest hedger in the world, which is a big move from a company that sort of said on a stack of Bibles, we will never hedge again, only a few years ago. That's the lovely thing about being the new MD. You can deny everything the previous MD said. And then you've got Polyus, Petropavlovsk, I can never say that, Russian. Those numbers, the ounces aren't so important. We're using, they don't have exactly the same amount as Regis. It's just, that's approximate because it's 5%. But so the Newcrest is the biggest Aussie. Then you've got Regis, who've been long time hedgers and have had a strong history of it. Harmony in South Africa, a recent arrival on the recent fall in the Rand where it popped up. Northern Star, a good size hedge book. You'll see when we do this relative to annual production how these change quite considerably. Evolution, very similar to Northern Star. You'll notice that Bill and Jake are always trying to do one out, do the other. At the moment, I think there's a clear winner in that race just at the moment, but stay tuned. I'm sure that the boys in Sydney will be fighting back. Saracen, the little battler, who've done incredibly well, come from where they were and with a good hedge book. And Oz Minerals, who will not feature again beyond this because they've just hedged their gold in their low-grade stockpiles. They're a copper company, so we won't include them in the other charts I show you. But interestingly, and it makes sense, they dug all this gold out of the ground and put it in their low-grade stockpiles. And, someone actually said, well, geez, we've spent all the money producing this stuff and we should hedge. But again, they don't hedge copper. They watch copper price fall for 5 years and never hedge copper because they say that's what their clients want. They said that their clients want exposure to the copper price falling. I don't think that's what they want, but, anyway, that's the way they run their business. And then there's the rest. There's about 3 million ounces amongst the rest, and about a third of the rest are our clients. It does seem that smaller companies tend to behave more like owners. Larger companies tend to behave more like agents, and we find that the management teams that act more like owners are more likely to be our clients. We like that, and so we tend to hang out with the smaller guys, but there's still a lot to be done on that smaller amount of ounces, and a lot of those are Aussies. So how do you actually break the world of hedges up into a slightly different way? Let's go back to 31st of December 2016, and there's about 15 companies in Australia that had started hedging back then. You can see all their ASX codes. But what we're looking at there is, on the vertical column, is how many weeks of hedging they have. So a 100,000 ounce producer is going to have, if they've got 100,000 ounces of hedging, they're going to have a 52 weeks hedged. So Newcrest down there, 4 million ounces a year, 10 weeks hedging, so they must have, whatever, they had, 400,000 ounces of hedging or something at that point. So you can see the spread. And what was interesting is there were hedge books anywhere from 1540 to about 1850, because that had been the range over that previous 12 months. We'd been from 1550 to 1850, which is the wonderful thing, the Aussie dollar giveth. Sometime the Aussie dollar taketh away. But in this case, we'd had a reasonable increase in the gold price, but a fall in the Aussie and $8 gold price had a very large range. And everyone had the courage, although some of those guys less than 10 weeks, of just putting their toe in the water, selling 5 weeks worth of gold forward up at 1800, 1850. But overall, that's where we were. What's been interesting to watch over the last couple of years is where gold producers got themselves into trouble in the past was when the gold price went up. They tended to leave their lower hedges sort of there and not use them and sell higher to create higher cash balances, but at the consequence of having those hedges forward. And when you saw that old diagram when it grew, a lot of that time as people went, when the gold price started to go up, people go, oh, don't talk to them about the hedge, just sell spot. Don't talk about the hedge, just sell spot. oh shit, we better get the shareholders to raise a whole lot of money and buy all that hedging back. It was a bit of a disaster. So one of the rules for our clients is you must always use your least attractive hedge first. It's kind of one of our mantras, and it's worked very well for our clients, and we're seeing good behaviours across the broader audience as well. So if you look, that's the kind of shift into March 17. Then you see the shift into June 17. You see sort of people clustering more to the right. Another rally, people have the opportunity. They're delivering into their lower hedges. They're putting new hedges on. And as we get to December 17, you're starting to get that clustering down between 10 and 30 weeks. People are starting to figure that's the kind of place they want to be. Then a few people put a bit more on. But generally, as we go through March, we go through June 18. And you see now, as of the sort of last numbers we have, I describe as it kind of got the peloton there between sort of 1680 and 1740, with people sitting between 20 and 40 weeks of hedging. And there's a few outliers there. Independents got quite a big book at a good price, the Tropicana, Dore and Regis over there. And you would have noticed those are paying close attention. The Dore's marker has hardly changed for the last 2 years, and they maximise cash rather than deliver into their hedges. It's a long-held strategy they have. They've got lots of cash. Very good companies, just a different strategy to most other people deploy. But if you look at it now, what you can see is that most of the people in Australia running these books have got between 20 and 40 weeks. Now, this is not going to blow them up. You're an investor in this company and the gold price goes nuts. They've got great prices locked in. 1700 to 1750 is a fantastic price. It's only been bettered by about 25 weeks in the history of mankind as Aussie dollar gold price being better than that. Because if gold price is going to 2,000, the Aussie is not going to 50 cents. If gold is going up, you're most likely to see that in a falling US dollar environment, rising Aussie. Certainly that's what we've seen in the past. There is a strong correlation. Might be a brief period where things go nuts and maybe the Aussie goes down and gold goes up. But if it does, what a lovely problem to have. You're invested in one of these companies that's got 20 to 40 weeks of guaranteed cash flow at around 1,700, generating a great margin, and how good it would be if they were wrong. But on the other side, gold goes back to 1,550. These guys have got time to adjust. And that's all that hedging ever does for you, really. It gives you time to adjust to a changed price environment, and that's what hedging's done. And what's interesting is to see then, if you look at that over time, that blue is the size of the hedge book. So you saw that growth from 2.5 to 8. Aussies have contributed from 500,000 to 3 of that in that audience, and the gold price at which they are hedged is climbing. So the NPV of all the hedges together is at 1,700. Good discipline, rising volumes, but with a rising hedge price. This is the way we want. What we saw in the early 2000s was rising prices, and the hedge price was getting further and further away because people weren't dealing with it, they weren't delivering in the right order. And certainly the kind of disciplines displayed by our clients and others has led to that. So that's a good picture. Investors need not be worried about companies that are hedging especially. And what's interesting then is let's look then at the stock returns for 1 and 2 years of those top 10 producers ex-Oz Minerals. And let's compare them to Barrick Gold and Randgold, who are very much in the news lately, and then the GDX and the GDXJ. So you can see there a little bit of black ink, a lot of red ink all round. So to make life a bit easier for you, let's sort those from best to worst. The GDX comes in there after 7 producers, okay? 7 producers that hedge out of 9 in the top 9 demonstrably outperformed the indices, demonstrably outperformed Barrick and GDXJ, who were sworn, Randgold and Barrick are both sworn non-hedgers. And then Goldfields and Harmony down there. Interestingly, Harmony in a 1-year return only -7 as opposed to -53 over 2. Harmony got religion and started hedging about a year ago, and that's been, I think, part of the reason they've been able to claw back. But it is interesting, and if you dig into the share prices of other companies that hedge in that other amount, you will find similarly that's the case. Now, again, what I want to absolutely be clear about is I am not suggesting that these companies have simply done well relative to their peers or the indices because they hedge. It's the other way around. Hedging is what good managers do to look after the interest of all the stakeholders in their business, and they have the courage to say, you know what, I don't know. Yes, I went to the conference and that guy said the world's going to end in 2 years' time. I went to that conference and Bill Evans told me the Aussie's going to be at 50 by Christmas. He just didn't say which year, because Bill Evans learnt that if you're going to predict price, you predict either price or date, never both. So he always says it's going to be down by Christmas. He just never says which year. So and all of his mates, Shane Oliver, they're all the same. So buy, commodities are cheap, right? Go right back to the thing, commodities are cheap. Some other commodities are much cheaper than gold, okay? So, you know, you want to put all your eggs in one basket. Gold is one part of where you want to be. And there's some Aussie producers at the moment making unbelievable returns and spending that money very wisely and buying other assets. And the people that are doing this and getting these better returns, they're going to get more shareholder interest. And when they say, I'm going to buy another asset, people are going to listen to that. They're not going to have to merge. And someone described Rand, this is not my words, but I loved it. Someone described Barrick and Randgold joining as like two drunks leaning against one another for support after a party. I don't think that's fair on the Randgold side of the equation. But anyway, so in the 2 minutes and 41 seconds I have left, I just want to touch on a couple of things about what does make it interesting to look at gold and just perhaps where we are. We have a scoring system that we use, and we score every gold market in all the different currencies. We look at our clients and other markets beside. And basically, when you see a green part of the histogram there, it means that the cumulative scores, either positive or negative, for all of those gold in those 10 currencies listed down the right-hand side, is positive or negative, okay? And what's interesting, you can try all these wonderful things to try and figure out if gold's an uptrend or downtrend, and trying to say to our clients, should we be aggressively covering? Should we be, you know, this is a time when you don't need to hedge, prices rising. What do? Would you be 20 weeks? Would you be 40 weeks? What's the right amount? You know, you do all this work, and then you look at that graph, and the overwhelming thing that says to me is that the US dollar gold price, when the US dollar gold price is going up, gold is generally going up in all currencies. And the one thing I do know is when the gold price is going up in all currencies, that's when you really have a bull market. So when gold is going up in terms of all currencies, that's gold is outperforming fiat currency or whatever name you want to give it. When gold is outperforming, that's when gold does well. And clearly you can see those places there where there's green and those periods of time. Now, the interesting thing for me is we had a very long period of green from 2000 to 2010-11, which is why I stood on the stage at this conference in 2013. Everyone was crying conspiracy. I said, conspiracy, forget it. It's like gold had gone up for a very long time. Did you not expect it would breathe in for a little while, having breathed out? One of the best quotes that I've heard about gold in recent times is a fund manager was interviewed. He's Jeremy Grantham, GMO fund, and someone asked him, what do you think about gold? And he said, oh, gold, we hate it. He's a generalist investor. He said, we hate it. We can't understand it. We can't value it. It doesn't give a yield. We hate it. But in 2008, when it started to patently outperform general equities, we had to buy some. And ironically, between 2008 and 2012, it was one of the best performing investments that we held. But you know what? We were never so pleased in 2012 when general equities started outperforming gold and we could sell all our gold. And they did. And what you're seeing there when we went back to red was very much when all the generalist investors who were buying gold, you know, to try and insure their portfolios, when they decided they could go back to general equities where they're much more comfortable with the stuff they don't understand, that's shortly afterwards we had that collapse in 2013. There was no conspiracy. It was just more sellers than buyers, which is what tends to drive markets. And I've got, if you'll indulge me for just a minute here, Bruce, one last thing to think about and to look at, and this is very important in relation to that comment the guy just made. That's a very long-term picture of the Dow-Gold ratio. That's not updated. I'll update in just a sec. But look back over time. If that's high, gold is cheap relative to equities. If that's low, gold is expensive relative to equities. In 1980, the year I finished high school, gold was 800, the Dow was 800, 1 to 1. Gold was incredibly expensive, or equities were very cheap. By 2000, you could sell your shares in the Dow and you could buy 40 ounces of gold. And if you remember Pierre Lassonde, one of my heroes, he came and he said, for God's sake, get over yourselves. Gold is cheap. Go out there and mine gold. And that ratio started to fall. And if you look at this and just take this thought home and dream about this graph tonight and stick this in your memory, the top one is the Dow. It's almost always going up, just reflecting inflation and the reduced value of money. The middle one is the gold price. The bottom one is the Dow-Gold ratio. When the Dow-Gold ratio is going down, that means every generalist investor in the world has to buy gold, and the rest of the time they don't give a shit about gold, and they're the ones with all the money. So we can all get excited about it, we can all have the other view, but at the end of the day, until the generalist investors want to come over and see what all the fun is about in the gold market, you need a red background on that chart, and it ain't red. And the thing that worries me right now is it looks a bit like 97, 98. It looks a bit like 97, 98. Late cycle, commodity currencies falling, commodities softening a bit, equities looking quite strong. Now, are we going into an Asian crisis? Are the Turkish and the Venezuelans leading us down that path? I don't know. But generalist investors have no interest in gold at the moment, and we need them to come back. You all work hard in the meantime, hedge your gold, make sure you're still here, because when they come back, it's going to be an enormous amount of fun. Just make sure you and the companies you invest in are still here when we get there, and to bridge that gap, hedge some gold. Thank you.